In your 60s, continue with what you were doing in your 40s and 50s. But also consider a home equity conversion mortgage, or HECM, for tax and Medicare planning. Once you hit 65, regardless of whether you're working or not, you will participate in Medicare Part A. Some will also participate in Medicare Part B. Income-related monthly adjustment around, better known as under the acronym IRMAA, IRMAA, or IRMAA, is a tax on your Medicare. It is very progressive, meaning that if your income is high 2 years ago, your IRMAA contributions will be high. IRMAA is based upon your modified adjusted gross income. You can manage it by using a HECM. Since what you pull with a HECM income out of is your home's equity, it is technically a loan. It is an income. So in years when you anticipate your taxable income spiking, manage that income down by not taking IRA distributions or by deferring Social Security. This can allow you to convert traditional IRA assets to Roth IRA assets, even as you're taking a taxable distribution to do that. Analyze the system, though. HECMs come with some upfront costs that need to be considered before you create the instrument. Also, strategically use charitable giving. Now, the first thing to note here is that if you're not charitably minded, stop right here. However, if you are, there are several tools you can use to make large enough contributions to move the needle on tax deductions. As I've repeatedly said, I'm not a tax professional. Take all these concepts with a grain of salt and review them with someone in that profession before you take any advice. Now, in your 70s, all the previous periods apply, all those techniques. But in my experience, those with wealth in their 70s are far more concerned with providing for their heirs rather than working the tax angle. Giving the money away, though, using a donor-advised fund is a simple, inexpensive way to take highly appreciated assets and provide them to charity. Another way is to use qualified charitable distributions from your IRA. In many cases today, this is a better approach than a donor-advised fund because ordinary income taxes are so much higher than capital gains tax.